All right, welcome. In this explainer, we're going to tackle a term that shows up on almost every company's financial statements, but often leaves people scratching their heads. Deferred tax. We're going to break down exactly what it is, and we're going to use the official rulebook, IAS 12, as our guide. Okay, so let's just dive right in. If you've ever stared at a balance sheet, seen a line for deferred tax, and kind of just nodded along without really knowing what it was, you are definitely not alone. So the big question is, what is this number, really, and why is it even there in the first place? So here's how we're going to break it all down. First, we'll look at the puzzle itself. Then, we'll talk about the two different sets of rules that create this whole situation. After that, we'll bridge the gap, see how this creates future bills or savings, and wrap it all up with why this matters so much. Okay, so the first thing to get your head around is that deferred tax isn't really about the tax a company is paying right now. Nope, it's all about what's coming down the pipeline, the tax consequences that are waiting for them in the future. And if you look at the standard itself, the whole point is crystal clear. It says that any deal, any transaction a company makes today, well, that's going to have an effect on its tax bill down the road. And the accounting rules demand that you recognize that future impact, whether it's good or bad, now, not just kick the can down the road. So where does this whole concept even come from? Well, it all boils down to one simple, kind of weird fact. Every company is basically living a double life. They have to play by two totally different sets of rules, one for their investors and a completely separate one for the tax man. See, on the one hand, you've got what we call accounting profit. Think of this as the story the company tells its shareholders. It's meant to show how the business is really doing economically. But then, on the other hand, you've got taxable profit. This is a whole different beast. It's a calculation based purely on tax law, and its only job is to figure out how big of a check to write to the government. And here's the kicker. These two numbers, they're almost never the same. So, you've got these two parallel universes, right? How in the world do you connect them? Well, IAS 12 gives us a few key definitions that act as a bridge between the two. Let's walk through them. First up, we have the carrying amount. The easiest way to think about this is it's the book value. It's the official number for an asset or a liability that's sitting right there on the company's balance sheet for everyone to see. And then you have its counterpart, the tax base. This is what the tax authority says that very same asset or liability is worth. And this value is figured out using tax rules, which often have totally different ideas about things like how fast you can depreciate equipment. And right here, this is where the magic happens. The gap, that space between the carrying amount and the tax base, has a special name. A temporary difference. And why temporary? Because eventually, over time, as that asset gets used up or the liability gets paid, that difference is going to disappear. It'll resolve itself. Let's put some real numbers to this to make it stick. Imagine a company has a machine. On their books, the carrying amount, it's worth 100. But the tax guys, because they have different rules for depreciation, say its tax base is only 60. Boom. Right there, you have a temporary difference of 40. But what does that 40 actually mean? Yeah, that 40 isn't just some random number floating around. It represents something real that's going to happen in the future. It's either going to create a tax bill the company has to get ready for, or it's going to create a future tax saving that they can look forward to. So let's talk about the bills first. When that temporary difference means you're going to pay more tax in the future, it's called a taxable temporary difference. And what it creates is a deferred tax liability. You can think of it as the company basically putting a future IOU to the tax office on its books today. Okay, let's go back to our machine example. We have that temporary difference of 40. What that tells us is that down the line, the company is going to have 40 more in taxable profit than accounting profit. So if we just assume a tax rate of, say, 25%, you multiply that 40 by 25% and you get 10. That means the company has to recognize a future tax bill, a deferred tax liability of 10 on its balance sheet right now. But hey, it's not all bad news. It can absolutely work the other way. Sometimes a temporary difference means you're going to pay less tax in the future. We call this a deductible temporary difference, and it creates what's known as a deferred tax asset. It's kind of like having a gift card from the tax office that you can use later. For example, let's say a company knows it's going to have about $100 in warranty costs for products it sold this year. For accounting, that's a liability they have to record right now. But the tax rules say, nope, you don't get a tax deduction until you actually pay the warranty claims. So, for tax purposes, the liability is zero.
That creates a $100 deductible temporary difference. And at that same 25% tax rate, it means the company gets to book a future tax saving, a deferred tax asset of $25.
Okay, so we've gotten into the what and the how, but this all leads to the big question. So what? Why should anyone care about this? Well, it turns out this isn't just some boring accounting exercise. It's actually a super important piece of the puzzle if you want to understand a company's real financial situation.
And if you look right into the heart of the standard, the core principle is actually pretty simple, but it's really powerful. It basically says a company has to acknowledge that what it does today is going to make its future tax payments either bigger or smaller. It's all about tying today's business decisions to tomorrow's cash.
All right, let's boil this all down. Key takeaway number 1, deferred tax exists simply because of timing differences between accounting rules and tax laws. That's it. 2, it represents a real future obligation or a real future benefit. And 3, recognizing it now gives investors a much more complete and honest picture of a company's financial position.
And that's our explainer on deferred tax. So we'll leave you with this question to think about. A huge deferred tax liability signals future cash going out the door, while a huge deferred tax asset is only valuable if a company stays profitable. With that in mind, how does this change the way you analyze a company's risk? That's all for this explainer.